Hi, I'm Adam,
This is Kevin.
and we are Tech Guys Who Invest. This is the place for business people and investors to learn all about investing. We offer a fresh perspective on what it's like to have a day job while investing, and we share lessons learned on our investing journey. Our vision is to educate and entertain you while adding tons of value to your daily commute. Welcome to our show.
Welcome, everybody, to another episode of the Tech Guys Who Invest podcast, where you learn how to invest wisely and safely. This week, we talked to Travis Watts, Ashcroft Capital's Director of Investor Relations. In this episode, Travis shares his journey from corporate worker to professional investor. He talks about how to leverage the role of investor relations to add value to a team and the benefits of passive investing and more wisdom that you can use as an investor. So a little bit about Travis. He is a full-time passive investor. He has been investing in real estate since 2009 in multifamily, single-family, and vacation rentals. As we mentioned, Travis is also the Director of Investor Relations at Ashcroft Capital. He dedicates his time to educating others who are looking to be more, quote-unquote, hands-off in real estate. So we hope you enjoy the show.
This episode of Tech Guys Who Invest is brought to you by Dreamstone Investments. Dreamstone is a multifamily real estate operator based in Atlanta, Georgia, and Tampa, Florida. Dreamstone specializes in finding and acquiring off-market value-add deals across the southeastern part of the U.S. Dreamstone creates immense value by ensuring the tenants are treated like residents and by adding the Dreamstone touch to each of our communities. To schedule a call to find out more about their current offerings and to see how you can partner with them, please send an email to info@dreamstoneinvest.com. You can also check out their website at dreamstoneinvest.com. We're so excited to have Travis Watts on the Tech Guys Who Invest today. Travis, thanks so much for coming on the show.
Adam, you bet. Kevin, thanks so much for having me.
Well, we're happy to have you on. And we know that you are investor relations for what you do. And how would you describe what investor relations is to individuals who don't have much experience in real estate investing?
Sure, yeah. So everybody's going to be a little different on kind of what their specific investor relations role is. I've held different roles in the past, and they were a complete 180 from what I do today. But I'll do my best to try to explain it kind of in a general term. So investor relations is basically both building relationships with new investors and prospective investors, trying to be an education piece, a resource for others, paint the picture of what multifamily investing is all about, what real estate private placements are, what apartment syndications are, and how they work. Additionally, it's taking care of your existing investors. So, investors have questions about updates and bank account information and, what deals are coming up and how the current offering, it is doing and how it's structured. And so I just try to be that resource for other people. We actually have two investor relations at Ashcroft Capital. We have Evan Pulowski. So he handles a lot more of the internal side with the existing investors. I handle a lot of the front-facing external side of investor relations. So before COVID, that meant going around nationwide to different conferences and meeting people face-to-face, joining real estate meetup groups, launching my own groups, perhaps, things like that, just to mingle and meet prospective investors. So that's kind of what it is in a nutshell.
Yeah, that's great. And for anyone in the industry, anyone who's into multifamily investing, they recognize Ashcroft Capital, but perhaps some people who listen to the show don't know who that is. How does one go about kind of seeking this role, or maybe a little bit about your story and how you got this role, Travis?
Yeah, it was an interesting journey. So, my story, I won't go in too long of detail here, but basically I worked in the oil industry, and that was a career and a job that I really didn't like. I was away from home a lot. I worked very long hours. I worked in horrible conditions, both hot and cold, in the Middle East where it's 120 degrees and Wyoming where it's negative 30 in the winter. And I was just so burned out with that. And, I couldn't see myself there 20, 30, 40 years as a career. So, real estate was really my solution. It was my out. So what I was doing is earning as much money as I could earn, saving as much as I could save, and investing as much as I could invest into real estate. So I used to do active single family homes, fix and flips, vacation rentals, all this stuff. And I eventually got to the point where I started doing passive investing, which is what we're talking about here, multifamily syndications, private placements. And the cash flow that I was able to generate off my portfolio investments allowed me to leave that oil field job, which was just such a blessing. So grateful for that. And so from there, to answer your question, I first went to go work for a brokerage house. So learn stocks, bonds, mutual funds, the paper asset world, figure out what Wall Street was all about and how that worked. That didn't last very long. I was in there maybe 6 months and I thought, I felt hypocritical. I was doing so much real estate and then telling people to buy mutual funds. And I just thought I don't buy mutual funds and I just can't tell people to do that. So I had to leave that industry. I went to go work for a small startup group in investor relations. That's really the only thing I could really do for them, and kind of built out that role and program for them, built them kind of a platform. And then I've been an investor with Joe Fairless and Ashcroft Capital for many years. I'm in a lot of their deals as a limited partner in their syndications. And, I just simply reached out to Joe one day and just said, look, I pulled out my iPhone. It was like a Saturday morning. I said, I'm speaking to you just as an investor, as one of your investors in many of your deals. And I just want to applaud you guys on what you're doing and your communication style and your reporting and your transparency and, answering my questions and, all these things, right? It was just to be kind and to let them know. And, then at the end, I kind of said, hey, look, also, if there's anything I can do to your, with your group in the future, as far as working with you, here's my background and what I'm looking to accomplish. And, Joe reached out, thanked me, nice video. Thanks so much. Appreciate it. I'm going to share it with the team, whatever. But he said, unfortunately, we don't have anything for you at this time. We're not hiring or anything. And so I said, okay, I didn't have high hopes for that. But about 4 months went by and Joe reached out to me and said, hey, I remember you sent me that video and you were kind of hinting at if we had some kind of investor relations role or something similar. And we actually are hiring for that now. If you'd like to apply, here's the link. And I probably shot him a video and resume and whole deal in probably 10 minutes immediately following that. And, went through the multi-process there and ended up working as director of investor relations. Then we brought on Evan Pulowski after I joined, as we discussed, to kind of handle the internal components because I was on the road so much. I was out there basically doing the things that Joe used to do, but he had a daughter and didn't have much desire to be out on the road and traveling away from home all year. And that was kind of my thing that I enjoyed doing. So kind of was able to fill that and add some value. So that's kind of how I got to where I am.
Nice.
A lot to unpack there. So first of all, thank you for sharing your story. And it's great that you took the action, right? And the worst that Joe said was no. And that no actually turned out to work out for you. But at the end of the day, the worst case scenario was, hey, it's not really a fit for us. In your case, it worked out, but you never would have had that opportunity if you hadn't taken action, B, almost, I guess, stepped out of your comfort zone. I'm not sure if that makes you uncomfortable, but it was something that you did that was like, oh, maybe I should give this a shot. I wanted to ask you, Adam and I are very much, we believe in real estate as an asset. When you were working in the mutual fund side, what made you say, you know what, I can't do this? And why would you say that people shouldn't invest in mutual funds?
Yeah, it's a good point. Well, first of all, I wouldn't say that people shouldn't invest in mutual funds. There's different assets for different types of people. And maybe perhaps there's a place for all of it. Maybe someone should have a little real estate, little mutual funds, little stocks, little bonds, whatever. Not a financial advisor or financial planner. Sure. But the things that really turned me off was, I kind of had an unfair advantage by getting into real estate myself first. I got to see the ROI. I got to see the tax advantages. I got to see how leverage works. I got to understand the tax code, the bonus depreciation, and cost segregation. There was so much I already had moving into that capacity. I was working with a lot of folks fresh out of college. This is like their first job with their bachelor's degree. And don't ask me how I got into that role. I got lucky, I guess. Nothing relatable to get that job. But there was no alignment of interest. There was no co-investment. It's like you're trained to say, hey, go buy this product. And when you're asked, well, do you invest in this? No. I felt pretty crappy saying that. And, and even if I did, which I did in some cases, it was such a small amount that who would have cared anyway, right? Like I own $1,000 of this share or something. So, again, back to just the pros of real estate. A couple things about the stock market in general just don't sit well with me, which would be the volatility. It would be the fact that if say you want to buy real estate, but in the stock market sense, so like a REIT, real estate investment trust, or something, a mutual fund that holds real estate. Well, two things are likely to happen. You're either going to be purchasing something that's overvalued because that's just kind of where the stock market is right now. So you're going to be overpaying for something, or things can go down 20% overnight just because the stock market collapsed. I think we're having a pretty rough day today in the markets, but because of COVID news, because of so-and-so gets on CNBC and says the sky is falling, things are in turmoil. And it really doesn't make any sense, because when you're investing in real estate, as your listeners know, and of course, as you guys know, nothing changes in the portfolio. The collections still come in, the tenants are still there, operations are still moving, but yet, we could lose 20% overnight in the publicly traded sector. And it just doesn't sit well with me. It's just hard for me personally to stomach. But again, I'm not bashing that industry. Right. I'm just saying different strokes for different folks. There's pros to it as well. Very liquid. I could invest 10 grand today and tomorrow say, actually, I want that money back. That's cool. You could stock trade and potentially get profits that way, but it's just not really my thing. Didn't sit well with me.
Yeah, fair enough. Thanks for breaking
Travis, one thing you said that I thought was really interesting is back when you had your W-2 and you were saving a lot of money and then investing it in real estate.
Yeah.
That really allowed you to one day leave that job, but most people don't know to do that. How in the world did you find real estate and know that, hey, if I invest, and especially in syndications, a lot of people don't know about that stuff. Can you talk a little bit about that?
Sure. Yeah. So when I got started, which was 2009, I didn't have mentors, coaches, programs, books, real estate groups, Bigger Pockets, podcasts. I had none of it. So like when someone said real estate investor, the only thing my brain could even come up with was buy a single family home in your own neighborhood, so to speak. Right. And that's what I did. And so it was kind of a scary time. A lot of people attribute investing in 2009 as, didn't you just time it perfectly? No, because in my market, we're still on a down slope, and I remember specifically asking friends and family, do you think I ought to buy or rent for a while? Everybody said rent. But, a couple things I knew. The house I bought had previously sold for about $165,000. It was on the market for $95,000, and it didn't need that much work. Wow. Number two was the government said, hey, we need home buyers. We need first-time home buyers participating to bring this market back. So they were giving out $8,000 tax credit to first-time home buyers. So I'm like, hey, 2 and 2 here, right? I got like a half off asset, plus I got $8,000 back in my pocket. That's like half my down payment. So it just, to me personally, it made sense for me to get started in that sector. Now, to answer your question so there's two sides of the coin. There's personal finance, budgeting, living below means, understanding how money works in a general sense. Then there's the investing side of the coin and everything else. So I was fortunate enough to have parents that were very frugal, that taught me like the benefits of using coupons and not buying crap you didn't need and not going above your means. Don't keep up with the Joneses, all this kind of, great stuff, which, was a roller coaster in my childhood. I would think that was really cool. And then I would think they were just being cheap and that was stupid. And then, it was like back and forth, but, and I made a fair share of mistakes. Not like I always make, personal and perfect decisions that way, but in general, that's who taught me that side of the coin, and it's very important. We all know that, Mike Tyson made $300 million and went bankrupt. We know Johnny Depp made $600 million and is bankrupt. And, it happens, right? You got to have both sides of that coin. Right. The investing side came from self-education. It came from what I mentioned I didn't have initially. So in 2015, I got serious about real estate, like much more serious than I've ever been. And I said, I want to do this long-term. I understand the benefits. I've done the Wall Street thing. I've done the private real estate thing. I just want a passive approach to investing. And I want the leverage and I want the tax advantages. I want the cash flow. So I learned about syndications in 2015 through a couple of people in my network, through joining a couple real estate investing groups, through podcasts, through books. And, it really changed my mind. I mean, it really opened my mind to what else is out there. I knew that people did this on a high level. I just didn't understand how. And I figured I'd have to be like a billionaire if I wanted to own apartment communities. I didn't understand you could put, 50K into an investment opportunity and be a partial owner in a 500 unit apartment complex. So that was kind of the evolution of it. And I just shifted from 100% active, like I said, flips, vacation rentals, single family, house hacking, all this good stuff, to 100% passive, with private placements, with REITs, with tax liens, with first lien notes, all these things that produce passive income that I didn't have to actually exchange my time for that cash flow.
Nice.
I love that, where you don't have to exchange your time for the cash flow. So that being said, how would you describe what an actively passive investor is?
Yeah. The irony, right?
Yeah.
So
catchy.
Yeah. Well, so Theo Hicks from the Best Ever community works with Joe Fairless as well on the other education aspect of Joe's companies. We launched a podcast called the Actively Passive Show. It's on YouTube. It's a once a week type of thing, 30-minute episode. And we go back and forth because Theo's mainly an active real estate investor. I'm a passive investor. And so we kind of joke and go back and forth about just kind of the pros, the cons, the ins, the outs of investing on the active and the passive side. So to your point, yes, I'm a passive investor. And when I say I don't exchange my time for the passive income, well, there is time involved, right? I have to get to know these general partners. I have to know how to vet deals. I have to keep up with the industry, with migration trends, with the economy, with the Biden versus Trump tax plan. Like, I have to put a little time and emphasis into being active to know what I'm doing, but I'm not actually running the show. I'm not actually finding these off-market deals and underwriting them and walking the units and doing renovations and putting together legal packets for investors. That's what I mean by being a passive investor. So it's more active than just throwing money in your 401k and wait until your 60s to take a look. But it's not active like I used to be, where I worked a 100-hour work week at a W-2 job. And then with every moment of spare time, I was in the single family space trying to max myself out and ultimately burn myself out doing so.
Nice. Well, what advice would you have for someone who's trying to decide whether they want to be active or passive? It's funny. We talk to a lot of people and they almost always come in with the default position of wanting to be active for some reason, and then a lot of them discover just how much work that is. And they're like, oh,
yeah, I think you hit the nail on the head, just how much work that is. In addition to how can you compete with others already doing it? I'm not saying that you can't, but I wrote a blog recently. It's called "What Type of Investor Are You?" A quick self-awareness guide. In there, I paint the profiles of active versus passive investors. By the way, that blog's on Bigger Pockets and LinkedIn if anyone wants to check that out.
And we'll link to it.
Yeah. And I think we even did an actively passive show on it. But basically, couple things to think about. So from a passive investor standpoint, think about the traits of a passive investor. And I'll name a few here. I made a couple notes. So lacks the time to frequently monitor investments, enjoys reading financial news, likes to own a little bit of a lot, AKA diversification, seeks to match, but not necessarily beat the market. These are often traits of a passive investor, not in all cases, but mostly. Now, if we flip over to an active investor, it would be likes to create their own unique strategy and or business plan. Doesn't necessarily value diversification as a top priority, seeks control over his or her investments, may have a unique skill or an upper hand compared to others or competitors in the marketplace, and then often does seek to beat the market. Often the mindset is, I can do this myself. I can do this better, and rightfully so if you're that type of person. But I distinctly remember being an active investor, doing a fix and flip and thinking, I'm not that good at this. This isn't me. This isn't my skill set. I'm not a handyman. I didn't have connections to construction crews or contractors, and I'm just trying to wing it. I'm just out here, and that's a lot of risk. That's the last thing you want to do is put yourself in a situation that's highly risky that way in terms of making money and investing. So for me personally, I had experience on both sides, but ultimately I found that partnering with people who are the experts, that are passionate about what they're doing, that are passionate about being in the business of real estate, I'd rather just piggyback off their success and be kind of the silent partner than try to beat them and say, I can do it better than you guys. Because quite frankly, I can't.
I love the self-awareness that you're talking about when it comes to thinking about what you want to do, because it's a big choice when you really think about it. And there are some people who kind of have to learn by doing. And do you think you'd come to that realization if you hadn't done it first, versus if you sat there and thought, what do I want to be? You seem like the action type of a person. So I'm just curious if you could go back, maybe thinking about that differently. What do you think?
Yeah. And I get asked this question a lot, which is, if you could start all over again in 2009, would you have just started as a passive investor? The answer is no. I do think there's a lot of benefit to immersing yourself, on the active side. I learned so much. I learned the fundamentals of real estate investing, despite the fact that I wasn't very good at it. I got lucky, though. There's something to think about. I got lucky in general, in terms of the market cycle and where I was at that time, right? I mean, there were some deals I bought at market value, did a little bit of rehab, sold them a year later for like a 25, 30% profit. But that's only because the market went up. If the market had been flat or declined, I would have been in the hole. And that's something to think about too, is it's all good until things shift and start going the other direction. And then competency and expertise really matter. But so there's different ways to approach it. Everyone's different. I think that honestly, though, I would start with some books and getting to know yourself and really being truthful with yourself on your strengths, your weaknesses, and most importantly, what do you enjoy? Some people are just out there doing this stuff for money. At one point, that was me. If you'd asked me about my big goals when, I was younger in my early 20s, it'd just make money. I don't know. But that's a bad goal. That's a horrible goal, because I didn't like what I was doing. I hated the job I was in, and I didn't want to be doing the real estate stuff I was doing. So it was really just, that's not sustainable. That's the bottom line. You're going to end up depressed or burned out.
Yeah, it's so important to love what you're doing, and to have goals that are meaningful to you. And if you don't, like you said, you'll just get burned out. I mean, you have to really be passionate about what you're doing, or eventually you'll fade from what you're doing.
Yeah, that's 100% it. So you got to think long-term, not just this year and next year, for sure.
Yeah. So, Travis, you probably run into a lot of people like I do who want to invest, but something's holding them back. A lot of times it's fear because they haven't done their first deal yet. They don't know what to expect, fear of the unknown. It's so almost counter culture, or counter, certainly not what most conventional financial advice that's perpetuated by the Wall Street system would have you think you should do. What do you say to those people who may be on the fence about investing in real estate deals like these syndications we're talking about, or other deals?
It's really interesting, because I honestly believe if a person does enough research, enough homework, both sides of the coin, which is rare, that's almost nobody, by the way, that I'm talking about, I think they would make the case for real estate. It would make the case that why I decided real estate was the path, opposed to Wall Street, generally speaking. But the sad fact is, like I said, most people aren't willing to do that kind of self-study and homework. Plus, you talk to a traditional financial advisor, and of course, they're not going to recommend things they're not getting a profit on, right? So there's going to be a case kind of against real estate. And this is our traditional financial system, right? I mean, Wall Street, the name of the game is assets under management, right? The more money they can collect in, the more they can pull a fee off of it. And that's their business model, right? If my portfolio is up 10%, they're pulling their 2% fee or whatever it is. If my portfolio is down 10%, they're pulling their 2% fee. I don't like that model. If I'm losing, why are you winning?
Right.
And that seems pretty basic and common sense, but that's how it works, And so with these syndication deals in multifamily, you have co-investment. You have a general partner investing in the deal often, not always, alongside you. So if that deal's going south, so are they, and often too, friends, family, their network are in these deals as well. So there's just more of that, hey, we're all in this together. Let's all collaborate and make this thing work and share in the profits, not equally, but together.
Right.
So yeah, that's kind of more or less my answer to that.
Yeah. Awesome. Love it.
So Travis, you've been at both passive and active investor. When it comes to analyzing a market or saying, hey, this seems like a good place for me to put my money into real estate, what have you learned from your time as a passive investor, as an active investor versus a passive investor? Like, what have you taken from being in part of the bigger deals versus when you were just doing things on your own?
Yeah, I think the biggest lesson is that you don't have to be an expert in everything. As I mentioned, there's a level of being active, which is a little bit of, reading financial news, keeping up with kind of the big picture. But here's how I do it. I find a lot of satisfaction in looking at migration trends and where people are moving from, where they're moving to, where businesses relocate to, what those reasons are, tax-friendly states versus high-tax states, and like the political climate there. And there's so much that I enjoy, but again, that's unique to me, and that's kind of my thing. But so I do that macro level study, right? And I just decide, hey, there's a handful of states I really like in general, maybe not every single market, but I like those states for various reasons. Well, so I kind of know that, right? That's like the homework that I do. And I know what asset types I like in general. I know that I don't like to do a lot of new development, new construction, because there's often not cash flow tied to it, and cash flow is my income. Again, this is all individual. I'm not bashing self-development and construction. That's just not a fit for me personally. So you start to identify from a macro level. You can do this through mentors, coaching, programs, books, podcasts. You got to have a little bit of self-awareness, a little bit of self-education, and then a macro level understanding of like the pros and cons between all this stuff. Then I defer a lot to the general partnership team. Why should I invest specifically in Fayetteville, North Carolina? I don't know. I like North Carolina and South Carolina in general, right? But why that specific market, and what's that 3-mile radius look like, and how are the school systems there, and what's the median income there, and what are the job opportunities there? I don't know the answers to that stuff. So I let the general partnership team fill me in and make the case for why they believe this is a great area and a great time and a great location, a great asset. And then it's like the trust but verify. I'm working with people that I already know and trust. But of course, I'm going to look into that myself. I'm not just going to be a fool and take things at face value and look at a pro forma and say, sure, I believe that's 100% accurate. And, it's projections, right? Nobody knows. So that's the approach that I take to kind of vetting out a deal or a market.
Yeah, I love it. I really like your approach a lot. Very, very smart. So Travis, we wouldn't be the tech guys who invest if we didn't ask you some kind of tech question.
Okay. All right. Fair enough.
So what is a piece of technology that you feel like really changed your life or improved your life in some way? And it can be from any era you choose.
These private placements have been around a long time, these syndications, right? But not many people have known about them. And that's primarily because the internet wasn't around. And now we have such great apps, and you've got, Google Maps and Google Streets. You can go take a drive down a neighborhood somewhere without having to fly out there. You can meet face to face like we're doing right now. If you live out in California and, a general partner is located in New York City, you hop on a Zoom call. It's free. It takes a couple minutes, and you get 90% of the benefit of meeting somebody face to face. And that's amazing. I would say video conferencing in general, Google Maps. If you think about it, how crazy is this? So many people are buying and selling real estate 100% online right now. I mean, houses are going sight unseen because you can do a virtual video 3D walkthrough of a house. You don't need to even book a time for a showing. It's insanity. And I love that, though. It's just a thing of our time. So I would just say, the internet, the digital age, the information age, whatever you want to call it, is a beautiful thing if you leverage it to your benefit, like we're talking about.
Yeah, it really is awesome to think about it in those terms. And if you would to try to describe the way some things are done right now, like the examples you just gave, to someone from only 15 years ago,
yeah,
it would blow their mind. So it's just amazing how fast it continues to accelerate.
Yep, 100%.
Travis, we've really appreciated the value you've added to our listeners, and we wanted to ask you, if somebody wanted to learn more about you, listen to your podcast, learn more about Ashford Capital, how can they get in touch with you?
Sure. Yeah. Best way is ashcroftcapital.com/connect with Travis. In there, I have a link, and I just give back free 15-minute Q&A calls, whether that's about a blog or a podcast or anything that I produced and put out there to the world. If you have any questions that pertain to you as an individual, even if it's not about multifamily or Ashcroft or whatnot, if you just want to talk general investing or COVID investing or any of these topics in more detail, happy to connect that way. I have a downloadable PDF guide on the same site, ashcroftcapital.com/connect with Travis. And that's a 20-page PDF about industry terminology, questions to ask a general partner, red flags to look out for. So much great stuff is in there. I'm on the Actively Passive show. You can just YouTube it. That's where we post a lot. It's also under the Best Ever community with Joe Fairless. And, I'm on Bigger Pockets and LinkedIn and Facebook and Instagram. Facebook and Instagram are at Passive Investor Tips, where I put out a bunch of content like this and little snippets of what I do. So feel free to check it out. Reach out if I can help you. And I appreciate Kevin and Adam, both of you, having me on the show today.
Oh, yeah. Thanks so much for coming on, Travis. We'll put all that stuff in the show notes, too, for your convenience.
Awesome. Thank you.
And thanks again.
You bet.
That's it for this episode of Tech Guys Who Invest. This is Adam.
This is Kevin. Thank you so much for listening to this week's episode. Be sure to subscribe to the podcast for the latest episode updates and to receive additional investor insights to help you invest wisely and safely. You can join the TGWI Insiders community at tgwipodcast.com/subscribe. Lastly, we would love to connect with you. The best way to reach us is by sending us an email at techguyswhoinvest@gmail.com. Thanks, everybody.